Today we're going to talk about something that can really eat into your investment returns: taxes on stock market gains. If you're considering selling some investments, you'll want to hear this, because how you sell can make a huge difference in what you keep. First, let's discuss cost basis. This is simply what you originally paid for an investment. So if you bought a stock at $100 and you sold it at $150, your cost basis is $100 and your gain is $50. Simple. But things can quickly get tricky. If you bought the same stock at different times and prices, each batch or lot has its own cost basis. That means each lot leads to a different taxable gain when sold. And on top of that, every time a dividend is paid and reinvested back into the stock, it creates another lot to manage. Let's use a simple real-world example to show why paying attention to cost basis matters. Suppose you own 2 lots of the same stock. Shares you bought in 2021 for $125 a share, and shares you bought in 2024 for $225 a share. And today, the stock trades at $250. If you sell, the 2021 shares produce a gain of $125 per share, while the 2024 shares produce only a $25 gain. At the 15% long-term gain tax rate, that's $18.75 per share in tax versus $3.75 a share in tax. That's a huge difference. And while you're getting the same sales price for each share, the tax you'll owe could be 5 times higher for the older lot you bought back in 2021. So at Baobab Wealth, we always stress it pays to be strategic about which shares you sell. Most custodians, like Schwab, will follow a default rule when you sell part of a position, unless you specifically pick otherwise. The default is usually FIFO, or first in, first out, but there are other choices as well, like LIFO, last in, first out, HIFO, highest in, first out, the low cost method, and tax lot optimizer. At Baobab Wealth, we change the default setting on your accounts to tax lot optimizer, or allow a specific lot ID to be used as well. Why? Because that gives us control to pick the lot with the lowest taxable gain, or to use a loss you've already realized to offset a gain. For example, if you have a portfolio loss somewhere else, you might choose to sell the older lot with the higher gain so you can pair it with the loss. Or you might choose the newer lot with a smaller gain to minimize current tax. Most major brokers now support this, but you'll want to confirm in your account what your default setting is if you're not working with us. There are a few more things you'll want to keep in mind. First, reinvested dividends count. If you reinvest dividends in a taxable account, each of those shares has its own cost basis. Don't overlook that. Second, take advantage of the 0% capital gains bracket if you can. For certain levels of taxable income, long-term capital gains can be taxed at 0%. Smart share lot selection can help you maximize that benefit. Third, remember about wash sale rules. If you sell at a loss and buy a new investment that is substantially the same within 30 days before or after, you trigger a wash sale, and the loss is disallowed. This rule applies only to losses though, and not gains. Finally, life change events can really complicate basis tracking. Things like death, divorce, inherited shares, and old holdings. These can all muddy your cost basis history. If you have questions, get ahead of the problem before you sell. The tax system is never designed to let you off easy. At Baobab Wealth, we believe you deserve to keep more of your gains and not hand them away needlessly. So before you press the sell button, consider which shares you're selling, what your cost basis is, and what default lot method your account uses. With a little planning, you can keep more of the money you've worked hard to earn. If you'd like help sorting through your holdings or structure a tax-aware distribution strategy, we're here for that and happy to help. Thanks for watching, and if you found this helpful, hit like and subscribe, and we'll see you next time with more insights from Baobab Wealth.